Hello, and welcome to Financial Accounting. Today, we will continue with the topic of accruals and discuss the effects of adjustments for accrued salaries. We will look at a couple of examples to understand how the adjusting entries to accrue salaries are recorded. Accrued salaries refer to the amount of salaries that have been accrued but not yet paid by a company. This amount is recorded in the salaries payable account. It is a liability account. When cash is paid to employees, the amount is transferred from the salaries payable to the cash account. Let's look at an example. Wheeler Company pays weekly salaries of $12,500 for a 5-day week ending on Friday. Let's look at two scenarios. We will determine how much we need to accrue at the end of the accounting period, assuming that the accounting period ends on Wednesday and on Thursday of the following week. In the first scenario, the accounting period ends on Wednesday the following week. This means we must accrue salaries for 3 days: Monday, Tuesday, and Wednesday. The amount of salaries accrued can be calculated by dividing the weekly salaries of $12,500 by the number of working days in a week, which is 5 days. The daily salary rate is $2,500. Next, we multiply the resulting amount of $2,500 by the number of days in the accrued period, which is 3 days. As a result, we have $7,500 for 3 days. An adjustment entry at the end of the month for accrued salaries includes an increase in salaries expenses of $7,500 and increase to salaries payable for the same amount. The reason for making this adjustment is to match expenses incurred with the associated revenues generated during the same period, regardless of when the cash is paid for the expenses. This is known as the expense recognition principle. Now, let's see how this adjusting entry is recorded. We know that liabilities increase by credit and expenses increase by debit. If you need to review the rules of debit and credit, I'm posting the link here and in the description to this video. We record the following adjusting journal entry as follows: $7,500 debit to the salaries expense account and $7,500 credit to the salaries payable account. If you're interested in learning more about the end of the period adjustments, I'd recommend watching the videos in the playlist called The Accounting Cycle, Accruals and Deferrals. I'm posting the link here and in the description box. Now let's look at scenario B. In this scenario, the accounting period ends on Thursday. In this case, salary is accrued for 4 days, Monday through Thursday. As in scenario A, we divide $12,500 by 5 days and then multiply per day rate by 4 days in the accrual period to get salaries accrued of $10,000. In this case, the adjusting entry at the end of the month for accrued salaries includes an increase to salaries expense for $10,000 and an increase to salaries payable for the same amount. An adjustment entry at the end of the month for accrued salaries includes an increase or debit in salaries expenses of $10,000 and an increase or credit to salaries payable for the same amount. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.